Hi, I'm Neil Hermon. I'm the fund manager for Henderson Smaller Companies, a role I've held for the last 18 years. Performance has actually been very strong. Just actually up to year to date now, we're actually up in NAV terms compared to the December 19, which I think, considering what's happened in this year in terms of the economic impacts, has been it's quite remarkable. We've outperformed our benchmark by around 8%, so very pleased with performance over the course of this year. As you know, it's a very low turnover, high conviction portfolio. Average holding period is over 5 years, so we're not chopping and changing the portfolio on kind of a day by day basis. We have been selectively adding new positions in stocks where we felt there was significant value. They've been impacted by COVID and not recovered, and the company themselves doing very well. So particularly in the kind of leisure and entertainment area, and also some of the companies that we felt were undervalued in this process. To fund that, we've essentially been trimming some of our positions, which we either had low conviction or had a very difficult COVID, or some of our better performing stocks where we felt valuation wasn't quite as compelling. The announcement of the positive trial results from the Pfizer vaccine and the Moderna and the Oxford University and AstraZeneca one have provided a real boost to the market overall. I suppose essentially that is providing a perspective that our life will return to some degree of normality during 2021 and could benefit the economic impact across the globe. So market's been very strong since that was announced early in November. I thought NAV in November itself was up 14% and strong again in December. In terms of what we've been doing on the back of that, if anything, really, we'd already positioned the portfolio for recovery. The market gives you very little time. Markets are very strong immediately after the reaction. It's probably too late to do anything. So actually, what we were doing in September and October by buying some of those kind of stocks which had significant upside on economic recovery positioned us pretty well. So we've actually had a very strong period of performance since early November. I mean, Brexit's been going on now for 4.5 years. So the initial vote was in June 16. So we've been living this for a long period of time. And there've been more Brexit up and down than I've had hot dinners. The UK mid small cap is almost a very much proxy for how Brexit's going. The stocks which move most on positive and negative news are those domestic Brexit baskets. So house builders, banks, challenger banks, leisure, hotels, bus and rail, retailers, which obviously, if you think about the UK small cap market, tends to be a reasonable big portion of it. So the FTSE 250 is a pretty good proxy for how Brexit is going. Clearly the conclusion of this would be mid and small cap will do, on the day it's announced or up to that point, will do very well if we get a Brexit trade deal, and will clearly underperform if they don't. And currency will again move in a certain direction. Sterling will likely strengthen if we get a Brexit trade deal, and we can if we don't. I think, looking beyond that, I think one thing about this is, whether we get a deal or no deal, and I think it's looking more increasingly likely we're going to get a deal. At least it will provide some clarity and certainty to the market. So we've been dealing with this uncertainty for the last 4.5 years. The market, the old adage, market hates uncertainty, loves certainty. The UK market is underowned, undervalued, and essentially is the kind of least or most hated market in the world, according to the Bank of America Merrill Lynch survey. So I think this clearly will provide a conclusion to that, and certainly help the perspective of international investors looking at the UK market. So I think that clearly a deal would be very positive for us. A hard Brexit without a deal would be initially quite negative, but on the other hand, I think it provides certainty. And I think there's a number of mitigating factors, which means I think that we could see a recovery into 2021. I think the kind of the conclusion is that we've had what's been a very challenging backdrop for 2020, but we've managed to negotiate it very, very, very well, and clearly pleased that we managed to. NAV is above where it was at the start of the year. Optimistic about the future. I think the vaccine news is very positive. It heralds a return to some degree of normality as we go into the second half of 2021 and 22. And the way we look at stocks is we are thinking about what's the earning capacity of those companies into those future years. And there's a lot of value out there in the market on companies that will return to normality, and their earnings will obviously increase. Additionally, I'm very positive about the outlook for M&A as well. I think we've seen an upsurge in activity in recent weeks. Private equity has significant cash to deploy, as do foreign companies. And we've seen a number of bids for companies in our portfolio and outside our portfolio in the UK market. And the UK mid small cap area is a prime beneficiary of increased M&A. So I think there's some certainly very good pointers to why 21 can be a much better year than 2020.